The operating decisions and the statement of earnings. So last was the statement of financial position. This is the statement of earnings. Same questions. How does a business activity impact the statement of earnings? How do we recognize and measure these amounts? And how do we report them ultimately on the statement of earnings? Okay, so you can think of the operating cycle or the cash-to-cash cycle as the time it takes to pay cash to suppliers. So there's 4 steps, right? Pay cash to suppliers. We might buy phone cases and glass and microchips. We have to process it and then sell those goods to customers. And then we have to collect the cash from customers. And then we have to pay our cash again to our suppliers. You can see the cycle, right? This is how cash flows. That's why that's why companies are said to have cash flow, because it's not a static number. It's always coming in and out. We've talked about this, the periodicity assumption. We need to report frequently, every year, sometimes every quarter, every month. And we need to give the information in a relatively timely manner, right? We can't wait 2 years to provide financial accounting information because it's useless, right? It's old news. You want the most recent news. We're not going to go too much into this, but what you need to understand is that the statement of earnings, or the statement of comprehensive income, has the results of continuing operations, and that's our day-to-day business. If ePhone is going to continue to manufacture phones long into the future, we're going to have earnings from those continuing operations. If we have a segment, let's say we have a research and division segment, and it's not doing very well, we're not really making any innovation, and we decide to spin that business off. We're going to sell it to someone else, maybe Intel, who can use that better than us. We have to separate the results, the revenues and expenses, from that separate operation so that the users of the financial statements understand, here's the segment of our income that's expected to continue into the future, and here's what's expected to not continue into the future. This might be gone in 12 months, okay? And this is because businesses often have more than one type of operation, right? We manufacture and sell phones. We might have retail operations as well on top of our manufacturing operations. We might do R&D, right? We might develop apps. We might have all these separate businesses under the ePhone umbrella. And as an investor, you care about how each business is performing. Okay, there's 2 ways to show your results of continuing operations: single step and multi-step. I'll show you some examples. This is the single step example. Very simple. We show revenues and gains first, then we show expenses. What is a gain and a loss versus a revenue and expense? So a revenue is something that we earn, correct? How do we earn revenue? We have to provide a service or we have to sell a good. Okay? How is that different than a gain? So revenues are related to our day-to-day operations. ePhone is in the business of manufacturing and selling phones. When we sell a phone, that's revenue. Let's say we bought some equipment a couple years ago. We bought it for $10,000. And it turns out that there's a shortage of this equipment on the market. And people are now willing to pay us $15,000 for it for some reason. Let's say it's still in good condition. And let's say we don't really use it anymore. Let's say we've bought another piece of equipment. And we sell this piece of equipment. So what happens? Well, we bought it for $10,000 and we sold it for $15,000. So think of the journal entry. What's happening? We're receiving cash of $15,000, debit cash 15. We're selling our equipment, decrease in an asset, credit asset 10,000. Do debits equal credits? No, we're missing $5,000. In accounting terms, that's called a gain. The difference belongs to us as shareholders. We happen to realize more cash than we expected from this asset. It was only sitting on our books at $10,000. Now the thing is, the reason why we call it a gain and not a revenue is so that us as investors know that this gains are one time, they're one off, they're not continuing. Revenues are usually meant to be continuing, okay? We are not in the business of buying and selling manufacturing equipment for a profit, right? That's not the reason we exist. We probably won't ever have this gain again. And we don't want it to create noise in the earnings, right? We want to understand, here's how much revenue we earn from selling phones, plus we have a gain from selling this equipment for more than we bought it for. That's probably not going to happen again. And that has nothing to do with our operations or our superior management of the business, right? Losses versus expenses. Expenses is money we spend with no future economic benefit. Here's actually a great, if you understand this, you understand a lot of accounting. When you spend money, when you credit cash, you have to have a debit, right? Where's the debit going to go? Broadly speaking, you can purchase an asset, which is a debit, or you can incur an expense. Expenses are debits and revenues are credits, and we'll show you how that works. Okay? The difference between the classification of an asset and expense, you might think asset's good, expense is bad, right? But they're both debits, and the difference is the asset gives you future benefit. When you purchase your computer, it's an asset. When you pay your cell phone bill, that's an expense. When you pay your rent, it's an expense, right? Because there's no future benefit. But you'll see from an accounting perspective that they're both debits, and it just depends on how you classify it. So a loss is the opposite of a gain, and it's usually one time, and it's usually peripheral to our business. Let's say that same example with the manufacturing equipment. Let's say we use it for a couple years, we don't need it anymore, we go to the market to try to sell it, and people are only willing to give us $3,000 for it. We say, fine, we'll take it, we're not using the equipment, and we sell this for $3,000. What's the journal entry? Debit cash, $3,000, credit manufacturing equipment, $10,000. Our accounting equation is not in balance, but we're missing a $7,000 debit. That's a loss because it's one time. It costs us as shareholders, but there's no recurring effect, right? We don't want to create noise in our earnings because shareholders might think, oh, you guys just lost $7,000. We'll say, no, that's a one-time loss. We're actually, our revenues and expenses are normal, right? Our day-to-day operations are normal. So this is called single step because we group revenues and gains and expenses and losses. The multi-step, okay, one thing to notice, net income, 53,000, for 53 million we'll call it. Multi-step format, net income is still the same, okay, except we segregate these components to make it more understandable and readable to users. Sales, less what on earth is cost of sales, gives us gross profit. Cost of sales is the cost of the inventory to us. If we're a retailer, how do you make money? You buy inventory at wholesale prices, cheaper, and you sell it for more than you bought it, right? H&M doesn't, if you buy a shirt from H&M, it didn't cost them $10 for that shirt because they wouldn't make any money. It didn't cost them $11 for that shirt because they'd be losing money. They probably got it for $4 or cheaper, right? So that cost of sales is the cost of the inventory. H&M purchased inventory for $4. What's the entry? Let's say they paid in cash. Debit inventory, because our asset is increasing, credit cash by we'll call it 4 million. They sell it to you as an end user for $10 or 10 million. What's the entry? Debit cash, credit revenue for 10 million. But there's a second part of that entry. They no longer have that inventory. They have to remove that inventory from the books. So they credit inventory for 4 million, debit cost of sales for 4 million. Our gross profit, you'll see this word thrown around a lot, gross profit is the profit we make from selling our good or service. The cost of sale is the cost directly related to that good or service. You can't sell the t-shirt without buying the t-shirt in the first place. Okay? There's other expenses, other operating expenses that aren't directly attributable to the sale of that t-shirt, but that you need to incur to earn the revenue. You need sales and marketing. You need ads. You need signs, right? You need to have salespeople. You need accounting staff. You need to rent retail locations. You might need a warehouse, right? All these things are necessary to happen for you to sell the t-shirt. It's just that this cost of sale is the cost of the actual inventory of the t-shirt, okay? We break it out this way because it's important to know how much are we making from selling the product versus what expenses are we incurring broadly as an organization. And notice how we have earnings from operations. An investor might look at this and say, okay, this is going to continue into the future. This year we made $55 million. And then we break out these other gains and losses. Loss on sale of equipment, gain on sale of land. Okay? We break these out at the bottom here because they're one-time, they're non-recurring. You still care because it does impact. I mean, we lost $2,000 because we had to sell equipment at a loss, right? It's bad, but it's not expected. It's not part of our operations, and it's not expected to be recurring. You'll almost always see a multi-step or multiple-step income statement because it's much more useful than this. Right? How do you answer the question, what's our gross profit? You'd have to do it yourself. What if you said, what's our earnings from operations? If you looked at this, you would have to do all the analysis yourself, right? Okay, this is another fundamental principle of accounting. There's two ways to recognize revenue and expenses. One is the cash basis, the other is the accrual basis. So what's the difference? The cash basis records revenue when you receive cash and expenses when you pay cash. So let's think back to the Walmart example. If ePhone ships $10,000 of phones to Walmart, and Walmart says, okay, we'll pay you in 6 months, we still need to get our cash in order, you say fine. On the day ePhone ships the phones, economically, in substance, has it recognized revenue? Yes, it just hasn't got the cash yet. The cash basis of accounting would say, no, until you get the cash, that's not revenue. So the problem is, what if the sale occurred December 1st, 2016, and we're not getting paid until January 30th? Well, a user of these statements might think, oh, ePhone didn't make any sales this year. If you use the accrual basis of accounting, you'd say, well, you did make the sale. You're going to recognize revenue in that period. You just haven't got the cash yet. Expenses is the same thing. If you only pay your rent at most people pay at the beginning of the month, but bear with me. Let's say your landlord was a nice person and they said, live here for a year and just pay me lump sum at the end of the year. You say, great. And 6 months in, you're trying to figure out, how much money do you have? Can you afford a new computer? Would you count the fact that you've already incurred 6 months of rent? You're going to owe 12 months of rent in the future? Yeah, you probably would, right? You might have incurred $6,000 or $7,000 worth of rent over 6 months. Just because you haven't paid it in cash doesn't mean you haven't incurred the expense. I mean, your landlord could take you to court if you don't pay him, say, you owe me money. The cash basis of accounting would say, no, that's not an expense until you pay the landlord at the very end of the year. So the cash basis of accounting is, it doesn't really reflect the true substance of transactions. Okay, as much as we care about the movement of cash and being able to have enough cash on hand, accounting transactions are not recorded on a cash basis. That's accrual accounting. Accrual accounting is required by IFRS, International Financial Reporting Standards. These are what we discussed in the first lecture. These are kind of the rules of the road, right? These are the rules that all financial statements have to adhere to. Okay, and when you're being audited, the auditor will make sure that your financial statements are in accordance with IFRS. Okay, the revenue principle. So let's go back to that example. ePhone ships $10,000 of phones to Walmart. Now, it's easy to say, yeah, well, we recognize the revenue, no problem. So revenue is actually one of the most uncertain and complex numbers on financial statements because it's hard to say when it's actually earned. So the people who create the accounting standards have identified criteria that have to be met for revenue to be recognized. Okay, and I'll try to give some examples. The entity has transferred to the buyer, ePhone is transferred to Walmart, the significant risks and rewards of ownership. What does that mean? What is a risk and reward of ownership of inventory? The risk is that the inventory gets stolen, catches fire, goes obsolete, right? The reward of owning inventory is you can sell it for more than it costs you to build it or to buy it. So, if we ship $10,000 of phones to Walmart, and we say, you know what, Walmart, anything you don't sell, you can return to us. And anything that gets damaged or stolen or goes obsolete, you can return to us, no problem. And let's say we're trying to make this sale to Walmart on December 20th because we're not meeting our revenue targets. An accountant will look at that and say, even though Walmart has our inventory, unless they sell it, we haven't really recognized revenue. In fact, if they sell nothing, they're going to ship it all back to us. So, have we transferred the risks and rewards of ownership in that case? No, we haven't. So in that scenario, there would be no transaction. Even if ePhone shipped the inventory to Walmart, you might want to keep track of the fact that Walmart has $10,000 worth of your inventory, but we cannot recognize debit cash credit revenue. We don't credit the inventory and debit cost of sales. We still own the inventory in substance, right? Walmart just happens to be holding it for us. The entity retains neither continuing managerial involvement nor effective control over the goods sold. If we sell these to Walmart and we say there's all these stipulations over what can be done with the goods, which is actually common, but then we say we have the right to in 3 months tell you to change the price or to tell you you can't sell it to a certain customer. This starts to get more complex, right? If we still have the say in managerial involvement or effective control over the goods, we haven't really got rid of it. We haven't sold it, right? We have to transfer those rights to Walmart. We have to say, here's the MSRP. We might have a contract separately that says, here's what you sell it at, but we might not have recognized revenue just because Walmart physically has our goods. The amount of revenue can be reliably measured and collection is reasonably assured. If we're selling to customers who are in bankruptcy or might not be able to repay us, we might not be allowed to recognize that revenue because we might not collect it, it's not reasonably assured, and we don't know how much we're going to realize from that sale, right? If we ship $10,000 of revenue to a customer and they go bankrupt the next day and they're never going to pay us, do we still recognize revenue? Maybe not. Maybe we just lost $10,000 worth of inventory, right? That's credit inventory, debit cost of sales, debit losses, you know. And the cost in respect of the transaction can be measured reliably. So the cost to incur the transaction, we need to know what they are. If we're open-ended on this transaction, we don't know how much it'll cost to ship or to fulfill Walmart's demands for where we have to deliver this to. We might not be able to recognize revenue until we know what the costs are. Okay, revenue can be recognized before cash is received, right? That's the classic example I talked about. ePhone delivers a shipment to a retailer. Assume that these criteria have been met, okay? ePhone delivers a shipment to a retailer. It recognizes the revenue on the day delivery is made, even if the retailer doesn't pay for 3 months. When we receive parts from a supplier, we recognize the inventory and the payable. That should actually say payable. Even if we don't pay the supplier for 3 months. Here's an interesting one. What if cash is received before revenue is earned? Okay. An example, and this works better with services. It's conceptually easier to understand. So for example, I take squash lessons. This is a real life example. What if you pay a squash pro $150 up front for 3 lessons? So the squash pro only recognizes revenue when he provides me with a lesson, right? He has an obligation to me. He can't just take the $150 and say, okay, thanks. He has to provide me with 3 lessons, right? So only after he provides me with a lesson does he recognize revenue. Every lesson he earns a third of the revenue, right? Assuming it's earned equally throughout the period. So how does this transaction, imagine day 1, I've given the squash pro $150. How does this transaction get recognized? The first thing is, where's the cash flowing? So my cash is declining, credit by $150. Squash Pro's cash debit $150. Okay, our debits don't equal credits because now I have net credits of $150. He has net debits of $150. The Squash Pro's perspective is what's called a deferred revenue account. Deferred revenue. And that's a liability. Remember, he debited cash for $150. He has to credit something. The credit goes to this deferred revenue account for $150. It's a liability. It's called deferred revenue, but it's not revenue. It's a liability. The reason it's a liability is because he has an obligation to provide me with service. If he says, you know what, I'm quitting the squash game, he's going to give me back the $150, hopefully. If he doesn't provide me with the lessons, I have the right to demand the money back from him. Okay? So on day one, there's no revenue. Notice how the deferred revenues plus liability. All that happened is he got cash, but he's almost holding that in advance payment. Right? After revenue is provided, after the service is provided, revenue can be recognized. Okay? So revenue, as I said, has a credit balance. So revenue increases by, you can't have negative revenue. Revenue increases by $50. And he's extinguished some of that liability. He no longer owes me $150 worth of lessons. He now only owes me $100 worth of lessons. So look what happened. Deferred revenue decreases. Now this is just a very simplified journal entry, right? Notice how I'm not even saying this is debit, this is credit. Notice how this is indented. But these are all implicit. Okay? So what happens is that deferred revenue with the credit balance gets debited over time, and revenue gets credited over time and increases. It's the passage of time and the provision of service that results in the realization of revenue. So other examples, rent collected in advance. If your landlord collects 6 months of rent from you in advance, they don't recognize all the revenue that day. They recognize it as they provide you with the right to use the apartment. Rent collected in advance eventually becomes rent revenue. Okay? So that was an example where cash is received. And actually, look up here. Situation 1. These are common situations of how you'll see revenue. This is situation 1. Situation 2, cash is received on the date revenue is earned. That's nice and simple, right? Let's say I pay the squash pro anytime I see him for a lesson. So say, I'll give you $50, you give me a lesson, we're done. There's no advance payments, right? In this case, he would recognize cash and revenue on that day because he's earned it, right? He's done the work to earn the revenue, and he's received the cash. And the third, and that's the one you're familiar with, is where we recognize revenue today, but we haven't yet received the cash. So in this case, ePhone, so this is situation 3. So in this case, the example is ePhone delivers phones but doesn't get paid yet. Think of if the squash pro had provided me with 3 lessons and I still haven't paid him. Every time he gives me a lesson, he's going to record revenue of $50, credit, debit account receivable for $50. And it's going to accumulate until I pay him in cash. What's going to happen when I pay him in cash? He's going to receive cash, debit, $150, credit AR, $150, account receivable, because he no longer has that amount receivable from him, right? I paid him, or receivable to him. So there's that. It's called clearing of a receivable, right? This is a credit balance, or rather, it's a credit to the balance, right? Here it was debit, here it increased, here it decreased. Rent receivable. Here's a good example. If you haven't paid your landlord for a few months, he or she is still recording the revenue every month. You still owe it to them. Okay. What's going to happen on their books is they're going to recognize the revenue, and they're going to recognize the receivable for the cash. Matching process. I guess like a boxing match. Expenses incurred to earn revenues in the accounting period should be recorded in that period. So again, sometimes you might earn the revenue, or rather you might get paid for the revenue you earned earlier than when you're paying the expenses, okay, for the cash. The important thing is you want to match those, because us as external users of the statements want to know what your profit is, how much it costs you to earn that revenue. Imagine one company, as an extreme example, that earned $100 of revenue and incurred $80 worth of expenses. If they weren't using the accrual accounting system, if they were using cash accounting system, let's say they collected all the revenue in 2016 and they didn't pay any of the expenses until 2017. Let's say they held back all that cash. how would their accounting statements look? They would show $100 of revenue in 2016 and 0 expenses, and therefore $100 of profit. We think, wow, this is a great business. They just make money without doing anything, right? They don't even have to incur any expenses. And then next year, as an extreme example, they incur all those expenses and don't earn any revenue. Now we're saying, oh, this business had 0 revenue and they incurred $80 worth of expenses. Not a very good business. In fact, both of those years distort the economic reality. The true underlying reality of that of the earnings are the company earned $20 of profit in that year, in 2016, right? So that's why we have to match the expenses to the revenues they help to earn. Okay, here's the reverse. We were going through the Squash Pro's revenue and liability transactions. Here's how I would record it on my books. I paid the cash, credit cash $150, but I now have the right to 3 squash lessons in the future. That's a future benefit to me, an asset. It's called a prepaid expense. Because it has the word expense in it, does not mean it's an expense. It's an asset account, okay? The important thing here is on day 1, I have not incurred any expense. Only when I use the squash lesson have I incurred an expense, right? I have the right to 3 lessons. After one lesson, what happens? Notice how cash isn't changing hands. I've paid the Squash Pro up front. I paid him January 1st. After I use one lesson, I have to recognize an expense. Okay, remember expenses have debit balances. And I recognize a third of that. And our prepaid expenses decline. What's my prepaid expense balance now? It's 100. That's only 2 lessons worth, right? Wouldn't make sense if I only recognize an expense, debit expense 50, no credit. First of all, it's overstating my prepaid expense because it should be 100, not 150. Second of all, my accounting equation will no longer balance, right? So what happens is this prepaid expense, this 150 actually unwinds. This is a debit balance, and what you'll see is it's going to result in cumulative over time. I'm going to recognize $150 worth of expense. It's just that the time hasn't passed. The service hasn't been provided yet for me to recognize it. So until the time the service is provided, the asset or the prepaid expense remains as an asset. I could maybe transfer those lists, right? I could ask the Squash Pro to refund me. I haven't really used anything yet. Prepaid insurance, that's a big one. Usually companies might pay their insurance in one lump sum up front, but you recognize insurance over the year because you're covered for a year, right? Yes? Yeah. Yeah. Good question. So the question is on this first item, supplies inventory and supplies expense. So the question is, well, how does the cash move and how does the expense move? So how it actually works is you might pay for supplies up front. You might buy a whole bunch of office supplies, we'll call it, pens and notepads and all that. So you might buy $100 worth of supplies, credit cash, debit supplies inventory for 100. As you use those supplies, it moves from the inventory, you credit inventory and you debit supplies expense. You recognize the expense for the usage of those supplies. Exactly. As the supplies wear out, the debit moves from the asset to the expense. Okay, so that was situation number 1, talking about expenses. Situation number 2, cash can be paid on the date the expense is incurred. You incur $200 worth of squash lessons in one day. That's a lot of squash lessons, but maybe you do it. You recognize the expense, you pay the cash, done. There's no deferral of cash. You paid the cash for the expenses, right? And the third example is where cash is paid after the company receives the goods or services. Think of ePhone's employees. They might work and get paid 1 week later, right? You work for a 2-week period and you only get paid once every 2 weeks. After 1 week, your employer has incurred an expense, right? They need to recognize that expense and that liability, the liability being the outflow of cash in the future when they're going to pay you, right? So they're going to recognize an expense today, okay, the expense up front, and that's for the work you've done, plus the payable, the liability. Debit expense increases, credit liability increases. Okay? When they go to pay, when they pay you your paycheck, they're actually not recognizing any expense. They're just clearing out the payable. Notice how this is asset and liability. The expense is recognized back here. Okay, so this is the same chart we saw in the last slide deck. Assets equal liabilities plus equity. This should be ingrained in your brain at this point. These are T accounts, right? Debits on the left, credits on the right. Debits increase assets, credits decrease assets, debits decrease liabilities, credits increase liabilities. Now we know the shareholders' equity, okay, so let's break this down a little bit. Shareholders' equity is on the right side of the equation, so it follows the liabilities methodology, where debits decrease the balance and credits increase the balance. Let's look at this account specifically, retained earnings. What is retained earnings? Just as a reminder, it's the cumulative impact of all of the profit, right? If retained earnings is just our net income or profit, then by definition, our revenues and expenses, which flow to the statement of income, are just, they're components of retained earnings, right? So because revenues and expenses are components of retained earnings, the difference between your revenue and expense equals your increase in retained earnings. Do you remember in the first week, I showed the relationship, how the net income from your statement of comprehensive income flows to the statement of financial position under shareholders' equity, or rather flows to the statement of retained earnings, and it'll be last year's retained earnings plus the profit you earned equals ending retained earnings. Well, less dividends equals ending retained earnings. So revenues and expenses have to follow the same rules as retained earnings, where a credit increases revenues and a debit increases losses. Okay, it's rare, you'll almost never see a debit to a revenue or a credit to an expense, but you can think of revenues form the right side of retained earnings and expenses form the left side of retained earnings. Why is that? We're increasing expenses by debiting them, but an increase in expenses means a decrease in profit, right? What does a decrease in profit mean? Less retained earnings. Less retained earnings means a debit to retained earnings. Before we go on, someone brought up a very good point, the accounting equation. I said these are all absolute numbers. Assets and liabilities are absolute numbers. Shareholders' equity can be negative. And that is a case where this actually happened, for example, in the States. Again, I'll use a house as an example. You buy a house for $1 million today, and you put in $200,000, and the bank gives you $800,000. You owe the bank $800,000. Financial crisis hits, like it did in the States in 2007, 2008, and housing prices drop. Let's say your house that you bought for $1 million is now only worth $750 million. You still owe the bank $800,000. How does the accounting equation balance? Well, assets is 750, liabilities is 800, shareholders' equity has to be negative 50. So this happens. It's a bad situation to be in. What are the mechanics by which it happens in the accounting world? Well, okay, so imagine you take on $10,000 of bank. Let's say we're a new company. We take on $10,000 of bank debt, and we're going to start a restaurant. And the reason I'm using restaurants is because historically the vast majority of them fail. Okay, so here's probably quite a real life example. We take $10,000 from the bank because no shareholders are willing to give us any money because they don't trust our business model. Bank gives us 10 grand, and they say, you owe us $10,000. Doesn't matter how your business performs. You know, they might even make the owner of the business sign a personal guarantee saying, I don't care if your business goes bankrupt, sell your house, sell your car, whatever it is, pay us back the $10,000, right? So let's say we take that $10,000, we have to pay rent, we have to buy food, we have to pay chefs, we have to get licenses, we have to furnish our restaurant. We go out, we spend this $10,000, some of it on assets, some of it on expenses, right? Think of paying chefs, that's an expense. Rent, that's an expense. And let's say nobody comes to our restaurant, unfortunately. And let's say we spent all our money within 3 months, we're out of cash, we can't operate the business anymore. Our assets are zero because we haven't earned anything and we spent all the cash. Our liabilities are still $10,000. In fact, we now have negative shareholders' equity. Now, how would that come through the financial statements? As we spend the cash, let's assume for simplicity that as we spend the cash, we're crediting cash, we're debiting expense. We're paying rent, we're buying food, which we'll assume goes bad in a week, so it's basically an expense as soon as you buy it. We're paying our chefs, I think I said that already. So we're incurring all these expenses and we're not earning any revenue. What does our statement of comprehensive income look like? Zero revenue, $10,000 expense. What's the result? Net loss, $10,000. Negative profit, $10,000. That now flows to the statement of retained earnings and the statement of shareholders' equity. Shareholders' equity is now negative $10,000. Bank debt is $10,000. The accounting equation is still in balance. Assets are zero. Liabilities positive $10,000. Shareholders' equity negative $10,000. So you can't have negative liabilities. You can't have negative shareholders' equity. And that's a result of recurring losses. It's not uncommon, actually, to see negative shareholders' equity. Okay, let's keep on moving here. All right, so let's look at some revenue and expense transactions. In the last section, we only looked at asset, liability, equity transactions, okay? These are sales transactions. ePhones sold new phones to customers for $3,520 in cash. The cost of the sales was $1,960. What does it mean, the cost of sales? It means we produce this inventory at a cost of $1,960. This is how we make profit, right? After buying all the equipment and paying all our people, it cost us $1,960 to produce the phones that we were able to sell for $3,520. So notice how this is one entry. There's only one reference, and it has 4 accounts. Okay, I'd say half the people got this wrong in the midterm last year. Okay, so it's conceptually a little bit challenging to wrap your head around because there's a lot happening. Think of what's happening. We're receiving cash. Okay, we're receiving $3,520 cash. And here's actually, when I was learning accounting, this is how I built it up in my mind. Don't try to picture the entire transaction at once, but build it up. Okay, what do you know just from the wording? We sold new phones to customers for $3,520 in cash. Okay, we know we're debiting cash for $3,520. Okay, the cost of these sales was $1,960. You can think of it this way, one of two ways. Either that means our inventory was worth $1,960, and just think of it conceptually. If you're selling these phones, you now have less inventory, right? It now belongs to someone else. So your inventory is declining. Okay, we're crediting the inventory asset by how much? $1,960. Okay, now well, we made a sale. We should probably recognize revenue. How much revenue do we recognize? $3,520, because that's the amount of cash we received. Revenue, remember, is a subsidiary of shareholders' equity, so it's on the right-hand side. So because revenue is increasing, and it's a subsidiary of shareholders' equity, which is on the right side, you have to credit it. And that leaves one piece, the cost of sales. You have to expense the value of the inventory, because think about your statement of comprehensive income. Think about your income statement. If we did not recognize this, if we just had these 3, what would our income statement look like? Revenue $3,520, no expenses, all profit. That's great, but businesses don't work like that, right? The other thing is your accounting statement, your accounting equation would not reconcile. So you have to recognize an expense for $1,960 for the value of the inventory, okay? And this just tracks what happens to the statement of financial position. Equality checks, debits equals Debits equals credits. Notice these are indented, right? Because we're crediting them. ePhone sold some new phones to retail outlets for $30.20. $20.20 was received in cash, and the rest was due from the outlets. The cost of products sold was $1,400. Same transaction as last time. We threw in one nuance, and that is we didn't receive all the revenue in cash. Now think back to the revenue principle. Assuming that we meet all those criteria, we should recognize all this revenue. We sold these phones, right? But some of it we sold $30.20 worth of phones, but only $20.20 in cash. The difference is $1,000, right? That is a receivable. They're going to pay us in the future, right? Otherwise, this entry is the same. Notice how this has 5 accounts. This is the most you'll see in a journal entry, 5 accounts. It's a lot. We have to think, but when you're thinking about this transaction, don't try to picture the entire transaction at once. Think about all the moving parts. We're selling some of our inventory. That asset account has to decrease. We're receiving cash, right? We have to recognize revenue. You have to recognize a related expense. And you might sort of piece it together one by one, right? The other thing to note is notice how this transaction goes debit, debit, credit, debit, credit. That's atypical. And that's because you can almost look at these as this has 2 components. This is the revenue, and this is the expense. Okay? ePhone received $345 from customers. So we received, let's say we received a bunch of checks in the mail. $75 was for sales that we made in December, and the rest was January new phone sales. What we're actually doing here is we only sold 270. How do we come up with that number? The difference between 345 and 75. We're actually clearing out the receivable, right? Some of the money that our customers owed us was paid. We already recognized that revenue when we booked the receivable. When we debited that account receivable, the trade receivable, we credited revenue. So now when the time comes to clear out the cash, we don't want to book revenue again. We'll be double counting. We need to clear out that receivable. So when you receive money, the question is, why are we receiving this money? Where did it come from? Did it come from a new customer who's buying a phone from us? Did it come from an old customer who already bought a phone from us but still owes us money? Okay? ePhone signed contracts with new clients and received $50 in cash. The company earned $40 immediately by performing service for the clients, and the rest will be earned over the next several months. So this is an example of me paying the Squash Pro, right? There's deferred revenue because, yes, our customer paid us upfront $50. We've only done $40 worth of work. Let's say we promised to do $10 of maintenance work, right? Let's say we sell them a phone, a cheap phone for, let's say the phone is worth $40. We also sell them a service package for $10. Like when you go to, when you buy a TV or a computer, they often offer you like a warranty package or a service package, right? To earn the revenue from the service package, they have to provide you with the service or wait until that time expires, right? So when we sell a phone, let's say we sell the phone for $40, and we also upsell the customer for a service package and say for the next 3 months, bring in your phone once a month, we'll clean it out, we'll upgrade it, we'll do your Android updates for you, all that. So to earn that $10 of deferred revenue, we have to provide service. Notice how we recognize the liability, right? Notice here how the service revenue is being shown as plus R plus SE. That's because R is a part of SE, right? Revenue is part of shareholders' equity. All right, ePhone paid $740 in advance for the following. We paid $160 for insurance for the next 4 months, $450 of rent for the next 3 months, and $130 for advertising to be run in February. Let's assume it's January 1st. So we've paid all of these service providers. They haven't done anything for us yet, right? Yes, question. Yeah. Yes. Yeah. Correct, yes. So the comment was the difference between the deferred revenue and an account receivable, they're opposites of each other. In the deferred revenue, you've received cash, but you haven't yet provided a service. In the account receivable, you provided a service or a good, but haven't yet received the cash. Now let me ask you a trick question, and this actually trips up like experienced accountants. How about the transaction where you and I shake hands and we say, all right, I'll provide service to you next month and you'll pay me next month. Cash has not changed hands and service has not been provided. There is in fact no journal entry there. The entry could in theory be debit account receivable, credit deferred revenue. So increase asset, increase liability. But that's not a real transaction. The accounting rules say that there's no substance to it. Someone has to have done something. Someone has to give cash or provide service before a transaction can be recorded, okay? But yes, that's a good point, that's accurate. Okay, so in this case, we just provided prepayments to our suppliers for some expenses that we're going to incur. All of these are examples of expenses we incur over time in the future. We're just paying money now. We're paying a deposit now, right? There's no expense today because time hasn't passed. We're paying cash. We have this asset, prepayments or prepaid expenses. Okay? Over time, what's going to happen is these prepayments are going to get credited and we're going to debit the related expenses. ePhone paid $731 for utilities, repairs, and fuel for delivery vehicle. All considered distribution expenses. So this is an example where we're paying the cash today, but instead of considering these expenses to be incurred in the future, we're saying, you know what, this is all, we filled up the trucks, we paid our mechanics for maintenance today. It's all sort of, there's no future benefit here. We've realized all these expenses. We're going to recognize the expense today. So you can see how the classification of when are we going to, what is this cash for? When are we going to incur these expenses? That's the challenging part. The journal entries are always a debit and a credit. That's not the hard part. The mechanics become very simple after a short period of time. It's knowing, is this an expense or an asset? And the lines become blurred, right? If you're a CEO, okay, so now that you know revenues are credits and liabilities are credits, right? And assets are debits and expenses are debits. So if you're a CFO and your bonus is dependent on the amount of profit the company makes this year, right? Because the board of directors might say, we're looking out for our shareholders. We're going to hire you, a CFO who has a lot of experience in this industry, to make us a lot of money. So you have a profit target. You have to earn $10 million of profit, and we'll give you a $500,000 bonus. So that CFO is going to be really incentivized to make the business run well, right? Earn a profit. He's also incentivized to use accounting trickery to make the numbers look better than they are. So here's the problem. Because, okay, which would you prefer, booking an asset or booking an expense? An asset, right? Would you prefer booking a liability or a revenue? A revenue. So all of a sudden, complex transactions, you say, well, no, this isn't a liability. The credit doesn't go to the liability side. The credit goes to the revenue side. The accounting equation still balances. You still receive the cash, let's say. On the debit side, when you spend money, you might say, no, that's not an expense. That's an asset. There's future economic benefit here. So all of a sudden, you can see how quickly it becomes easy to manipulate these numbers to say, think of a company that's debiting all of its, every debit goes to an asset and every credit goes to a revenue. It has no expenses and no liabilities. It looks like a great company, right? But that unravels eventually. I mean, that's how accounting fraud happens. Okay, so this goes back to those relationships. Statement of earnings is revenues minus expenses will give you net earnings or profit. I don't know why it does that. Sorry, guys, for all the lines. But net earnings is profit. The profit goes to your statement of changes in shareholders' equity, right? You start with beginning equity. You add net earnings, subtract dividends. Don't worry about the other components. That'll give you your ending equity balance. That ending equity balance is just your shareholders' equity, right? And then you have your assets, one of which is cash, and that's the statement of cash flows. We talked about the statement of cash flows a little bit in the first lecture, but that shows how the cash is moving. Now, here's the interesting thing. Each of these transactions results in a direct impact in the statement of financial position and the statement of comprehensive income. Okay? The statement of cash flows, as we'll see in future lectures, is actually derived from the balance sheet and the income statement, the statement of financial position and the statement of earnings. Okay? So the statement of cash flows can be almost thought of as a subsidiary statement. There's no entry that impacts the statement of cash flows alone. Okay? Every entry, every journal entry, every transaction will impact either the statement of financial position or the statement of earnings, or both. Okay? And then that change will get reflected in the statement of changes in cash flows. Asset turnover. So a good point was brought up. Remember how I showed you the current ratio in the last slide deck? The current ratio is the ratio of our current short-term assets to our current short-term liabilities, and it shows how liquid you are, right? You as a student might want a high current ratio. You don't want to have credit card debt that you can't pay, right? But for companies, it's sometimes frowned upon to have a very high current ratio, like 10 times. That means for every dollar of current liabilities, you've $10 of current assets. And that means that maybe you're hoarding cash. Maybe you could be using that cash more effectively. Maybe you could pay down some debt. Maybe you could return to the shareholders. Maybe you could invest in long-term assets. Right? Maybe there's something you could be doing with all those current assets instead of just holding it as inventory, right? Maybe your inventory is building up and you say, oh, this is good, my current asset is inventory. Problem with inventory is it goes obsolete pretty quickly. Who wants to buy an iPhone 4? No one. If you're still hoarding iPhone 4s, you might want to show a lot of inventory, but it's worthless, right? So there's almost a sweet spot for current ratios. It's less than optimal to have a very, very high current ratio. So asset turnover, and so you can think of that as efficiency. How well is a company using the assets it has to generate profit? Because that's ultimately what we care about, generation of profit and cash flow. Total asset turnover is sales, revenues, okay, so let's call this revenue, divided by total assets. And we measure those total assets on an average basis. We take the beginning assets, meaning January 1st, the ending assets, December 31st, add them, divide by 2. So just the average, because the assets fluctuate, right? We don't want to pick end of year versus beginning of year, because revenue is earned over the period of the year, right? So we take total revenues accumulated throughout the year, divided by the average assets. And now assets, from a business perspective, their only purpose is to generate revenue. Why else would we have assets in the business, right? The only purpose of a business is to generate revenue and profit in the first place. You, as an individual, might own art because you like it, right? Because it provides you with utility. You might own a car because you have to get to work, which you do ultimately use for profit, but you might own guitars because you want to make music, not because you expect to generate revenue from them. Businesses only own assets to generate revenue. Okay, so that's why we care about, well, how much revenue, how many dollars of revenue are you generating per dollar of assets? How efficient are you at using those assets? So in ePhone's case, we might measure their total asset turnover ratio, $150,000 of revenue, and average assets are about 93. That gives us 1.63. That means for every dollar of assets, we generated $1.63 of revenue. Now that in and of itself doesn't mean much to us. You have to compare it to how we've done in the past. If historically our ratio was 1, we've improved a lot. If historically our ratio was 2.5, something's wrong. If our competitors are all right around 1.6, we know we're sort of middle of the pack. If our competitors are way higher than us, that means they're way more efficient than us, right? The return on assets is a very similar measure, except it looks at profit, net earnings, as a function of average total assets. And it tries to answer the same question, except instead of looking at revenue, which you care about, ultimately profit is arguably more important, because if you're earning $100 of revenue and it's costing you $110 to earn that revenue, you're not doing very well, right? Your profit is negative 10. So you might look at this ratio. Now, the reason we add interest expense is a little bit theoretical, but it's because, think back to the accounting equation or the example of the house that you bought for $1 million. You and your neighbor might own identical houses and have two different mortgages, right? You might have a $500,000 mortgage and they might have an $800,000 mortgage, right? That doesn't impact the value of the asset, value of the house. Companies can have different amounts of debt, okay? And yet they might still have the same amount of assets. The difference there is the bank paid for more of the assets compared to how much the shareholders were paying, right? Shareholders put in less, bank put in more for one business, bank put in less, shareholders put in more for another business. Both businesses, let's say, have $100 of assets, okay? So the thing is, the company with more debt is going to incur more interest expense. How does interest expense work? Every month, you have to repay the bank what they lent you plus interest, right? Same way your credit card works, same way OSAP works. So the problem is the company with more debt is going to be incurring more interest expense, and that's going to pull down profit. But what we're looking at is the operations, the ability of the assets to generate income, regardless of how much debt you have on the balance sheet. So we add back interest. So if your net earnings was $100, and that's after deducting $10 of interest, your net earnings before interest is $110. So you might have two businesses that actually have, let's say one business has net earnings of $100, and the other has net earnings of $80. And the second company with profit of $80 has $30 of interest expense, and this company only has $10 of interest expense. If you add back interest to both of those companies, you'll find that their net earnings before interest is the same. It's 110, okay? The reason they have different profit is because they chose to have different amounts of debt. So in that case, the return on assets ratio, the amount of dollars generated for each, the amount of dollars of profit generated for each dollar of assets is the same for those companies. And again, you can use this as an efficiency measure. How well are the companies using the assets that we give them? Okay, key takeaways. The statement of earnings, actually I didn't talk about earnings per share. Let me give you a quick rundown of that. Net earnings, right? Here's a problem with size. Okay, well I don't have a good example here. Net earnings, let's say we made $100 this year. And let's say we had 20 shares outstanding. We earned $5 for every share. Why is that relevant? If we earned 100 actual dollars, let's say E-Phone is a tiny company, $100, not a lot of money. We only had 20 shares outstanding. Let's look at Apple, who might have earned billions of dollars. How can we compare Apple to E-Phone? We need a basis. We need a metric, right? If Apple has $1 billion of profit and 1 billion shares outstanding, its earnings per share, for every share, there's $1 of earnings. E-Phone has 20 shares outstanding, and it made $100, E-Phone is actually more profitable on an earnings per share basis. Each shareholder is entitled to $5 of earnings, whereas in Apple's case, you're only entitled to $1 of earnings. So the earnings per share is often disclosed at the bottom of the statement of comprehensive income because it gives you a sense of size, of scale. Companies are very different in size, but you want to understand what that means for you as a shareholder. Okay? Let me go back here. Single step and multi-step format. Multi-step is what you'll see most often. That breaks out cost of goods sold, gains and losses. Cash and accrual basis. Cash is not IFRS. Accrual is IFRS. There's 3 situations for revenues and expenses. And in fact, try to tell me a situation outside of one of these 3. There isn't one, right? So this is sort of all-encompassing. So you can try to memorize this, which would, I mean, it might work. You can try to memorize your debits and credits. But actually, if you know one thing, if you know that assets increase with debits, you know the rest. Because it's all exclusive, right? If assets increase with debits, you know that they have to decrease with credits. And that's on the left side. And you know the right side of the equation is reversed. And therefore you know that liabilities increase with credits and decrease with debits. Okay, so all you need to think of is assets increase with debits, and the rest should flow. And that's it. Okay, thank you.